Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. So we talk a lot on this show about the impact of things like rising rates, volatility, and inflation on equities and certain parts of the fixed income asset class. But today we're going to dive specifically into closed-end funds. Are they being impacted as well? Well, joining me now to discuss this is my colleague, Sangeeta Marfadia, closed-end fund analyst with the Chief Investment Office. Sangeeta, wonderful to see you. Thanks for joining me.
Thanks for having me, Anthony.
Yeah, so Sangeeta, listen, look, we talk about volatility all the time. We're all looking for rate hikes this year. The Fed has indicated possibly 6 times we're going to see rate hikes. But there's consistent geopolitical tensions with Russia, Ukraine. We're all concerned about the rising inflation. When will that actually taper off? There's so much going on. But with closed-end funds, are they subject to this type of volatility that other asset classes are?
Yeah, Anthony, definitely closed-end funds do fit in that category. To start off, let's just touch upon basics of closed-end funds for our listeners in case someone's new to closed-end funds. So closed-end funds trade like stocks. They can trade either at a discount or premium to its net asset value. What that means is either the stock price is higher than what the underlying assets are really worth, or the stock price is lower and hence the premium or the discount. The big advantage that closed-end funds have is the fact that they can use leverage. So closed-end funds can borrow based on short-term interest rates. They're investing in long-term assets, and that allows them to pay out a higher distribution. This becomes a very attractive proposition for retail investors, especially people who are looking for monthly income, as most closed-end funds do pay out a monthly distribution. So given the use of leverage, closed-end funds therefore can also be very volatile. In addition, closed-end funds are a retail product, not much in way of liquidity. And then we have this herd mentality. If somebody starts selling closed-end funds, you kind of have overall pullback in the market price of the closed-end funds.
Right. And I know we just flashed a snippet or a page from the latest municipal market guide from the Muni Bonds team, where you always get a section in there for closed-end funds specifically. And right there it says that you see that the funds that you cover are down close to 10% year to date. So that's a significant drop. Is this because of the concern about rate hikes coming in March? As we said, Jay Powell himself has even said we might see a 0.5 percentage point hike in on March 22nd, the next meeting.
That's exactly why closed-end funds are down. So if we look at across the board closed-end funds we cover, we have double-digit declines in market price of several of the funds we cover. Muni funds, equity funds, high-yield funds. And this is typical. When rates rise, people start to worry about their fixed income portfolios. In addition, not only there are worries about rising rates, but we've also seen volatility in the equity markets. S&P 500 is down almost 10% so far this year. That's also adding to the sell-off in closed-end funds. What we've also seen, though, is the underlying net asset values have not gone down as much as the market price, and that's resulted in widening of the discounts across the board.
Right. And as you said, closed-end funds are susceptible to pullbacks in equities. They're not completely separate from what's happening on the equity side, right?
Exactly.
Right. So let's then let's focus on the muni funds, municipal funds specifically, which were highlighted in the spotlight section of the municipal market guide that we just referenced. How have they performed this year, and how does that look, versus past rate hike cycles? Is the question.
So this year, muni closed-end funds, let's just talk about January first of all. We've had the worst January in about 5 years.
Wow.
Worst monthly performance since COVID began March, April of 2020. If we go back further in the previous rate cycles, so Fed raised rates in 2015, 2016, and 2018. Before that, we had taper tantrum in 2013, and that's when funds were down roughly the same where we are right now. So in 2015, 2016, Fed raised rates only once. 2018 is where we saw 4 Fed increases. Even that year, funds were down high single digits, but the underlying net asset values that year, in fact, were flat. Right now, muni market is down about 3.3% year to date. Closed-end funds are down 10 to 12%. And in addition, the underlying net asset values are down 5%, which is muni market adjusted for leverage.
So it's not quite exactly the same scenario as what you're painting from back in 2015 through 18. It's a little bit, there's more loss here in value.
There is more loss also because we're not seeing Fed just go once this year. UBS CIO, our forecast is for Fed to go possibly 6 times, which you can compare to 2018. And we wonder if some of this sell-off, keep in mind, Fed is not going to raise rates till March. We're not having an emergency meeting of the Fed. So most of this decline has occurred ahead of Fed even raising rates. So in some ways, I feel a little bit the sell-off has been overdone, especially when you start to look at where the distributions are, what the discount levels are in the muni market itself.
Right, so in the business we say selling ahead of the news with the expectation of the rate hikes that are coming.
That's exactly what's going on with closed-end funds,
Right.
whether be it muni funds or fixed income funds. Preferred funds is another good example, which is preferreds are very interest rate sensitive asset class, and we've seen similar declines in the preferred market as well.
So great. So here's the $1,000,000 question. If we're looking at current valuations, is this an attractive entry point then? As we just stated, closed-end fund investors are selling a little bit ahead of the rate hikes that are coming down the pike.
Exactly. I think if you are a long-term investor, you are looking for that income. The valuations here are attractive. Overall, if we look at the muni funds themselves, every muni fund, national, leverage, state funds, on average, the discount is about 8 to 10%. We're also looking at distribution rates well over 5% on national funds. Some of the names that we cover actually are paying 540, 550. That's tax-free, federally tax-free income. If you tax affect that, your taxable equivalent yields are closer to 7% for investors in higher income tax brackets. So if you are a long-term investor, you are looking for this additional income, closed-end funds do provide that additional income over other asset class, other structures. So you are getting paid, for example, in a muni fund, 520 versus a muni bond or a muni ETF or a muni open-end fund, you are not going to get all of that additional income. Of course, that all comes attached with volatility,
of course,
and pullback in the markets.
Which there doesn't seem to be any stopping of volatility as tensions in Ukraine and Russia continue, and we're, of course, anticipating inflation to at least continue to grow until about midway through the year, as CIO has stated. And if you look at that chart we just had up on valuations, and you said the discounts are currently at about 8%, we're heading towards the levels that we saw in February of 2020. So, at some point, as you said, it seems like there's an attractive entry point here.
Exactly. It is an attractive entry point. And also keep in mind, when you start to see distribution rates over 5%, I think you begin to see some of the investors come in just for value and not so much. They may not be looking for muni income, but over 5% yield does become attractive to crossover buyers as well. And that's what's going to bring in. And even last week, we did see a little bit of strength in the muni market itself, as 10-year Treasury yields fell below 2% at 193, 194. Muni market did stabilize a little bit. Of course, yesterday was another down day for the muni market and equity markets as well as closed-end funds.
Right. Sangeeta, thank you very much. It's always good to have you here. Thanks for joining me.
Thank you for having me.
Of course. And for more information from Sangeeta and the CIO, you can visit ubs.com/views and make sure to follow UBS on our various social media platforms like LinkedIn, Facebook, Instagram, and Twitter. Plus, you can check out our past episodes of UBS Trending on demand. And as always, if you have any questions about how this could impact your own portfolio or want to talk about closed-end funds, make sure to talk with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.